So hello again. I am Philip Williams, better known as Phil, the founder of Fill the Gap. And if you're following Fill the Gap or you recently or you've been following for a long time, you would recognize that the main focus of Fill the Gap is to help you find and fill the gaps in your financial knowledge so that you can make the best possible decisions with your money. Now, I don't know what you would normally be doing at this time of day, and I know that time is precious. So the fact that you have carved out some time to sit in front of a screen with me, that says something. And yes, I think, of course, everybody, the obvious thing is you want to learn how you can start investing. But I think more than that, if you dissect it, I would say the reason that you've taken your time to be here is because you have some important questions about how you can best manage your finances and you want more out of life. So maximum respect for you to choosing to spend your time today because it's an investment in yourself. So thanks very much for joining the Fill the Gap I Invest webinar and welcome again. Now, it's the 11th of June today, which means we're somewhere close to the halfway mark of 2025. And no pun intended, but it's a great time to take stock of where you are and in terms of you and your money journey for the years. You might have had goals or ambitions at the beginning of the year. You may have fallen off, but that's all right. And to make the most of the time today, I want you to focus on some of these specific issues, some of the worries, some of the concerns, some of the burning questions that you may have as it relates to managing your money. You might say, Phil, listen, my biggest concern is, well, listen, I just need more money. Probably need a bigger pay raise. I need a big bonus. And I hear that. But I also want you to consider that the reality is if you are having challenges or you don't know how to manage small amounts of money, you're going to have the same challenges. It would be very difficult to manage large amounts of money, right? So if you won the lottery or you inherited a fortune, you became a millionaire, unless you know how to manage yourself or manage your finances, you can find yourself in a situation where you're doing the most, you upgrade your life, and you're right back where you started with a little bit of money or no money at all, wondering where did all the money go, right? So with that in mind, I have a question for you. I just want to ask you, do you know where all your money goes, right? And if you don't, that's okay. If you do, great. That means that you have laid or you have the beginnings of a solid foundation for a healthy financial journey. If you don't, I don't want you to beat up. Do not feel overwhelmed. Do not feel daunted. Sometimes your money journey can feel like that. And a lot of times you might actually be doing a lot better than you know or than you think, right? There are things that you can do to change the outlook for your financial situation, right? But before we get into the nitty-gritty of investing, I just want to review what I would call the 5 pillars of PTG. Just to clarify, PTG stands for Fill the Gap. And pillar number 1 is budgeting for your life, not for anyone else, but budgeting for your life, the life that you want to live. Pillar number 2 is saving with a purpose. And I'll just stick a pin here to say one of the first things that you should be saving for, even before you start investing, is to have an emergency fund, have emergency money to give you that peace of mind, because the mishap or the misfortune that you think is never going to come or is never going to happen, it will happen, right? Saving with a purpose, as pillar number 2. Managing your debt wisely. Very, very important. Setting smart financial goals. And if you've never written down a financial goal, I want you to think about that. Because if you don't have the time to write down your goals, then you have to ask yourself the question, how much does this goal really mean for you? Once you have these 4 things set in place, I think it's a great place to start investing. I simply don't want you to be despondent. If it is, you say, well, Phil, I don't have emergency money. Don't fall off the webinar, right? As I said, if setting smart financial goals, today you maybe say, listen, it's the middle of the year. I want to start investing by January 1, 2026. And that's a great financial goal to write down. Today, we are focusing on pillar number 5, which is investing to create wealth, right? Again, as I said, if you have gaps, please know that you're not alone. And there's a lot of things that you can do to rectify that. You just have to resolve from today, moving forward, after this session, that you're going to be deliberate and taking steps to fill the gaps in your financial knowledge. Now, on the topic of investing, before I share the presentation, right? I want you to think, probably write on a notepad, or if you're brave enough to type in the chat one word that you or something, how you feel about when you think about your hard-earned money, your life savings, how you feel about investing in. You could type it in the chat, you can write it on a notepad if you're not that comfortable. This is just to say that we are all at different stages on our financial journey, right? We have different life circumstances, different hopes, different dreams, different, tolerance to risk, how you might feel about it. But I want you to clear up something now. If you've been led to believe that investing is only for people who are wealthy, investing is for only people who have the big degrees and understand finance, and if you're thinking, well, boy, I really have no business in messing around with my savings like that, I am here to tell you that with the right foundation and trusted help, as far from true, investing can also be for you. And my aim is that by the end of this session, you'll have a better understanding of how financial assets, financial markets work, and how they are relevant to you. All right. So I'm going to share my screen. And as I said, any questions that are popping up in the chat, even if I don't get a chance to answer all by the end of the session, certainly I will respond to them via social media or whatever means of means that we can stay in touch. I'm going to try to get all of the questions. So I'm just going to share my screen and let me know. Probably just put a thumbs up and let me know if you're seeing. Let me know that you're seeing the presentation. Yes. 2. I'm seeing, okay, great. So you're seeing the presentation. So I just went through, this is an beginning investor session. And you may want to know, some people don't know where to start. You want to know investments, is for you, what type of investments that you can make and what options that you have available. I just want to start by saying what, a lot of times when people think about investing, you think about doubling your money overnight sometimes or getting rich very quickly. And investing is that, yes, when I said growing your money, but not doubling your money overnight, tripling your money overnight. So when you see these things, people, invest 1,000 and get 50,000 by this time, invest 10,000, get 100,000 guaranteed. There's no one that can guarantee returns. Returns are never guaranteed. And certainly the first question that you should be asking anybody that comes to you with those schemes is what's really backing the investment, right? What is backing the investment? If they can't answer you, and they, ask them also what are their credentials. So that's what I want you to think about, right? The fastest way to grow your money is slow and steady. And every time that you get a salary, every time you get a paycheck, every time you earn, if you're an entrepreneur, every opportunity or every piece of income that you get is an opportunity to contribute to the financial goals that you have. And the fastest return that you can give yourself is, think about this. So sometimes some people say, well, if I have a lump sum, I have 10,000, I have 5,000, I'm going to put it down. And that's great. That is great. But I think people have the idea, well, I put down this 5,000, it's going to automatically go to 7,000 or 10,000. The fastest return that you're going to get on your money is every month consistently contribute to that 5,000 or that 10,000 or 100,000 that you're putting down. And I'm calling numbers just because I know as I said, people have different income situations. The space you want to be in is how much money you need to figure out what money you have available. If you have a good picture of your financial situation, what you should be investing. Why I say it's the fastest return, because if you are earning 10% on $100 and you're earning the same 10% next month on that $100, okay, so you have $110. But if you contributed another $100 the following month, now you're earning 10% on $200. And if you did the same thing the month after, now you're earning 10% on $300. And that's the power of compounding. So the fastest return that you can get is being consistent, being deliberate, and it is slow, it is steady, but over time, what investing is really taking your money, putting it in an asset and working towards a goal. There's short-term investments, there are medium-term investments, and there are long-term investing. But the idea is putting your money in a space where you can get compensated and it can earn and can help you to achieve your financial goals. That's what investing is. Today, we're going to talk about the traditional asset classes, which are stocks, bonds, mutual funds, and I'll touch a bit on exchange traded funds. I know there's a lot of sexy stuff out there. There's crypto, there's Forex, and these are things that I would never knock. I would just say that if you're getting into these things, just be cautious. Don't bet the whole house. If you have $100 to invest, don't invest the whole $100. Don't invest 90% of it. Probably take 5 cents of what you have to invest. If you have $1 to invest in an asset, very risky asset, you see, I want to take a shot and see what this is going, what crypto might work out for me, or what Forex might do for me. Those are very risky type of assets. Also, you have to have someone who has the requisite skills and the knowledge to trade those assets and invest for you if you don't have the time, and you have to have the desire to learn. So today we're focusing on stocks, bonds, and mutual funds. I'm going to break down exactly what those things mean and how you can access them. So starting with a bond. Bond is just a fancy word for a massive loan. Governments and corporations borrow. So if you would have seen in the news earlier, and this is not an advertisement, but this is the most recent example that I have, you would have seen Massey would have raised a bond, two bonds equaling 300 million each, about just roughly 600 million. Those are examples of, and I'll show you what a real example would be like. The government of Trinidad and Tobago has to borrow from time to time to do different things. And whether it is to fix roads, whether it is to build bridges, whether it is to pay salaries. So corporations and governments borrow. It's the same way, think of when you go to the bank to get a loan for a car, get a mortgage, start a business. That's what a bond is. The person who is borrowing, or the entity that is borrowing, is known as the issuer, and the investor is the bond holder. So basically, entities come to investors, and what investors are going to look for, they looking to generate returns. So a bond's particular things to pay attention with the bond is the coupon rate, which is the interest that's paid on this bond, and that's what investors get paid on. So a bond is just a fancy word for a gigantic loan. So when you invest in a bond, there are different types of bonds. So there are long-term bonds. This is an example of an actual, if you're not familiar, so the National Gas Company of Trinidad and Tobago, government entities also issue bonds. So this is an actual bond that is in the market. This is the principal. So these things to pay attention to. The coupon on this, or the interest rate that investors are being paid, is 6.05%. The principal, which is the amount that National Gas has borrowed, which is 400 million, and the maturity date, which is the end of, when the money has to be repaid, the principal, is in 2036. So this is an actual bond that's in the market right now. The credit rating is more or less aligned to the credit rating of Trinidad and Tobago, and that triple B that you're seeing there, that is what investors look at to determine if they're going to lend money and at what rate. So anytime you hear a bond got downgraded, or the government of Trinidad got downgraded, or the United States got downgraded, any country that moves from A to B to C, then to going into areas where that are non-investment grade, those things are what investors look at. So the credit rating is just, think of the way the bank is going to assess your income and your debt service ratio before they give you any type of loan. These are, this is an actual bond. So I thought this would be a good example for you to see of an actual bond that's in the market right now. A stock. So there are two ways that a company can issue money. They can either borrow, so companies can issue bonds, as I just explained earlier, or they can say, listen, I'm going to give up a part, I'm going to put some shares on the market. Now, again, this is not an advertisement. The most recent example that we'll have of this, some of you, I'm sure most of you would have seen MedCorp, which I think is due, the offer is open, it's still, I think it's due to close on the 13th in a couple of days. Again, not an advertisement, but a recent example of an entity. MedCorp, just for everybody, think of Sinclair Medical Complex. They offer a bunch of services in the health sector. They're issuing some shares, and they put it on the market because they want to raise funds. So this is the other way that a company can raise capital. And the reason that they do that is either, a company might raise capital to, acquire another business, build a bigger building, get computers, expand, whatever companies, whatever their strategic objectives are. they may need to borrow from time to time. In this case, or raise capital, sorry, from time to time. The two ways that you can earn from a stock is through this fraction of ownership, because it's really ownership and you're paying for management. When you decide to purchase a stock, you're saying, hey, I think this company has some great prospects. I've seen what they've done before. They have a history. I can see their financials, or somebody has looked at their financials, and I trust the judgments of this person to say, listen, this company has done well, and I think that they're going to continue doing well based on their story, the historicals. And that's why you will invest in a company. You don't just invest in a company because somebody say, hey, this is good. It's a family member that say, hey, don't miss out on this. That's not, you get someone that actually can do the due diligence and make a recommendation for you. But a stock is ownership in a company, and you have a chance to share in the profits. And the other way that you earn is through capital appreciation. Let's say, for example, a company puts their shares on the market, and they were doing well, but they do really well the following year. Profits are up, and investors are like, boy, I want to invest in this company. When there are more investors clamoring at a stock, it pushes the price up. So capital appreciation, meaning you bought a stock for $1, now it's $1.50. That is capital appreciation. The board of directors or the owners say, listen, we've made profits, and we want to declare dividend, and we're going to let shareholders have a share in these profits based on the fraction of their ownership. So that is stocks and bonds. A mutual fund, think of all of us here in this on this webinar. We decided we're going to pool our funds together, and we're going to give it to a fund manager. A fund manager is also known as a portfolio manager. They do the hard or heavy lifting or due diligence in selecting investments. And sometimes that might be tricky. You may have the ability to do that, which I can get to a little later. It's not as difficult as it seems, but sometimes you don't have the time. So one of the benefits of a mutual fund is paying an experienced portfolio manager, experienced analyst who do all of that work to say, well, this is a good investment to put in the pool for everybody, because they're going to get, returns from this investment going forward. Once the returns are generated from the securities in the portfolio, they're passed on to the investors. So that's a mutual fund, a basket of investments pooled together by investors, managed by someone who is a skilled professional who has all of the requisite skills. So whatever degrees, whatever background, more than likely it's in finance or economics or a combination of. And these types of people are the ones that manage these funds. And I'm going to share the different, because I know we've seen things here. I'm going to give you what are actually real life practical examples of mutual funds in Trinidad and Tobago, and stocks that are available and things that you can invest in. Before we move on, when I spoke about different risk tolerance, different investment goals, there's short, medium, and long-term goals. There are different types of mutual funds, and it depends on this basket, the blend. Some of them are more suited for certain types of goals. So the mistake I never want you to make is to know, listen, you're putting your money in a long-term fund, but you really it's a short-term goal. You might need the money in 6 to 12 months, because there's risk in a long-term fund, as I will explain going forward. Stocks are riskier than bonds, right? Stocks are riskier than bonds for this reason. Stocks don't promise that dividends would be paid, and stocks move in tandem with the economic cycle. Also, so with a bond, because it's a contractual agreement, when interest is going to be paid, when the principal, the returns there are lower. So when you are selecting a mutual fund, it is very important. The number one question to ask the service rep, any CSR, anybody selling you, any wealth manager selling your fund, what is this fund made up of? And what is the likelihood of this meeting this particular financial goal that I have? I have this goal that is 5 years out. I have this goal that is 10 years out. I have this goal that is 20 years out. What type of fund should I invest in? Where should I be putting my money? So let me break this down for you. If you have money that's invested and you want a lot of growth and you have time, then you want to put it in an equity fund. An equity fund, so when you hear stocks, shares, equity, it's all the same thing. It's part ownership in a company. And a mutual fund that has a lot of stocks in it, say 90% weighting in stocks, or 85% and up in stocks, or even 70% and up, will have a higher growth probability for you and a greater probability of you achieving long-term goals. Somebody might say, what, boy, Phil, you just mentioned that stocks are risky, so I may not want to put all my money into an equity fund. I'm not that comfortable. I might more opt for a balanced approach, which is 50% in bonds and 50% in fixed income and 50% in equities. Because if the stock market is not doing well because the economy is not doing too well, the bonds are going to bolster my dollar, and I feel a bit safer with this investment here, my whatever investment that you're making. I feel that this lump sum and the money that I continue to contribute, I want to have it more balanced. And so I am looking for a balanced mutual fund. Fixed income fund is really used for sometimes short term, but it can also be a space to park money for like an emergency fund, or space to park money for 2 to 3 years where you can get a decent return. It's invested in bonds. I gave the example of a natural gas bonds, but there are many different bonds out there, government bonds, many different corporate bonds. For some of these companies that you're familiar with, some of the places where you shop, there are many different, and I'm seeing some hands raised. I may not be able to, so I cannot see the chat right now. What I'm seeing is that, so I'm not being rude. What I'm seeing is that my whole screen is full. So I will, when I minimize this presentation, if anybody has their hands raised, I will get to the questions after, because I can't see in the chat. All right, sorry about that. And then for like really, really short-term money, this type of fund, money market fund, that's great for, again, for emergency money, anywhere between 1 to 2%, that's the return, but it's 100% of it is in short-term securities. So I'll give you an example of short-term securities. People borrow for different time frames. Once you start to move past a year, 2, 3, 4, 5 years, you're in the territory of a bond. Anything less than 365 days, I'm lending you money for 30 days, I'm lending you money. So some of even the big banks that they borrow money for different periods, for 200 days, 275 days, 365 days. And those assets also pay, because it is really saying, okay, I'm lending you this money to do, to do this, whatever you're going to do with it, for these days, and I will pay you interest for these days. That's a money market type of interest, very short. So the interest, or the what you earn, is a lot lower, but that's probably one of the safest or safer funds that you can invest in. That's probably the best place to put your emergency money. So these are the 4 different, there are a host of mutual funds, but the basic type of mutual funds: equity, balance, fixed income, and a money market. And they are going to show these examples of the types of funds. This is just a snapshot of actual funds in Trinidad and Tobago and again, this is not advertisements, but these are funds in Trinidad. I just wanted to give you an example. There are different kinds of funds from different financial organizations. And when you go to any one of these organizations, what you want to do is sit down with the rep and make sure you ask all of the questions that you need. So TT income fund or US dollar income fund, if you have US dollars, are geared towards a more safer type of investment. And depending on the type of fixed income fund, more short to medium term, right? These are the equity funds that are available. Again, different players in the market. This is no advertisement, so you're not going to see any returns here, but these are examples, real live examples from different financial institutions that offer different type of funds. The reason I put this slide up is because I want you to know that they're well over 50, close to 60 registered mutual funds, and registered meaning that the regulators have inspected, done their homework to say that, okay, this product is fit and profitable on the market. They may not endorse it, but they may say, listen, we allowing this product to come on the market. So registered products, that's the ones that you want to go with. You don't want to go with these kind of schemes that people telling you, listen, put your money here and it's going to get doubled down there. So another question to ask is, is this a registered financial product? Are you a licensed financial planner? Are you a licensed financial advisor? Can I see your credentials? These are things that you want to ask anybody coming to try and sell you anything. How the stock market works? So simple. I use the example of the IPO MedCorp earlier. A company wants to raise money. They come to the market, they decide, you know what, we're giving up, we're going to sell some shares, we're giving up a part ownership of this company, and these shares are sold on the stock market. The 2 ways, as I mentioned earlier, members of the public have an opportunity to buy and sell these shares. When a lot of people want to buy shares, is because they say, listen, boy, I'm seeing great prospects for profits. I love what the management is doing, and I love this company because I've seen, I've seen them in the past, and I think they're going to continue to do well. When a lot of people want to sell stocks, it's because they think there's a change in either the economy or just a change in the fundamentals. And fundamentals is really what the strength of a company. They may not be doing so well because of competition. They may not be doing well because management made bad decisions or they took on too much debt. And companies, can make poor decisions the same way you can make poor decisions in your personal finance. So I will just stick up in here to say that, your business policy should always be, when you're thinking about what you want for yourself, the decisions that you make with your money. Any well-run company has a policy, and I want you to know that your dreams, your hopes, your aspirations is very, very serious business, and you have to be making the right decisions to push towards and to move towards these dreams and aspirations. When the company receives a profit, they pass it on to shareholders. So based in a nutshell, that's how the stock market works. Companies want to raise capital, they're listed on a stock exchange, and investors come to the stock market to determine and say, you know what, I want to either buy or sell these shares. I put this up here because many of you, if you follow me and you've been following me for a long time, if you're not, you may not, but I always want you to know that you don't have to be a consumer. You can also be an investor. So if you drink alcohol, if you've purchased a car from any one of these entities, if you have a loan from any one of these entities, if you participate in any types of the products and some of the things that you're seeing on the screen here, these are actual logos of some of the companies that are listed on the Trinidad and Tobago Stock Exchange. Listen, if you're eating KFC, it's that Prestige Holdings. If you're eating KFC, you're contributing to the profits. If you're eating Pizza Hut, eating all those things, Subway, you're contributing to the profits of Prestige Holdings. If you're drinking alcohol, you're contributing to Angostura Holdings. If you're shopping at Massey, in the grocery, if you're buying cars, as I said, everything here, if you have purchased an item or you are locked in with a loan or anything, you contribute to the profits of these companies, and you can also have a share in the profits that they share when the board of directors declare a dividend. I just want to have this up here visible for you so that you can see. What you need to buy stocks? Well, you need a brokerage account. And a brokerage account is really your passageway. It's the middleman to get to the stock market. I'm going to show you the list of brokers. So think of opening a brokerage account just like opening a bank account. And the brokers have fees, which I will explain how those fees work. So you open the account, you go to the broker with your 2 forms of ID and your proof of where you're working or whatever letters are there, things that they ask you for to open an account. You put the 2,000, you put 5,000, you put 10,000, 100,000, whatever it is you have. Because even if you're starting small, the only way for your money to grow and go big is for you to start somewhere. So even if you're starting small, remember every contribution counts. And I will urge you not to think about, well, boy, someone else has this amount of money and how, maybe my money is not good for this. Maybe I will wait for a lump sum to start investing in the stock market. I'll say no. The longer, the faster you put your money to work for you, the longer that you have it, it's there earning, and the greater opportunity you have or more opportunities you have to contribute. So this is really how you will have an opportunity to buy, a list from these companies here. You have to open a brokerage account. Brokerage accounts, they charge fees. I'll just remind you here again, if you have high credit card debts, you don't have any emergency funds. And if you're extremely risk averse, I'll stick up in here. Extremely risk averse means, boy, I invested $1, tomorrow it's 95 cents. I'm not going to sleep well at night. Then that's something to think about when you're investing in the stock market. But if you can deal with the ups and downs because okay, it's 95 cents a day, but it might go back up to 100 and then 105, 110. It might fluctuate. If you can deal with that, then the stock market is for you. So you have emergency money, you don't have high credit card debts and exorbitant amount, then I think it's a right space for you if you don't have access, if you don't have a brokerage account. For the person that's saying, well, Phil, boy, from the time you say risk and being risk averse and my dollar going to 95 cents, boy, I might just put my money in a money market fund or fixed income fund because I know it's not going to fluctuate and I'm going to know what I'm going to earn. The only thing I will say about that is there's risk in not taking risk. I want to say that again. There's risk in not taking risk. And the risk is you're not giving yourself the best opportunity. You see the big life financial goals, some of the things that are going to take some time for you to achieve down the road, 5, 10, 15, 20, 25 years old. So that could be sending a child to university, buying a second home, starting a business, things that you well, it might seem like a dream, or it might seem dreamy because you don't know how you're going to achieve it. But I guarantee you, you take steps to plan these financial goals and set smart financial goals and write them down and you break them down, you can get there. And one of the ways to get there is by investing consistently, right? So I just said, let me do that because a lot of times I certainly wouldn't be encouraging somebody to say, no, start investing and you haven't had all the boxes checked. This is a list here of the brokers. Again, this is not an advertisement. This is a list of the 8 brokers. Brokers offer different types of services, but different types or different levels of services in terms of, one might offer tax consulting, one might offer very high net worth individual invest. They're just different types of packages. But what each one of these brokers will do, they give you access to the stock market, right? So if you had, it doesn't matter which one you go with. What matters is, because if you bought a particular share at having this particular brokerage account or you bought it with another, it's the same share. It's just the type of service that you're looking for. And I would say the main thing is the entry level. So some of them would start off, I think I know 2 of them for sure, start off at 2,500. Some of them go as high up as 25,000. Again, so don't let that be daunting. So if you have 2,500, you can actually open a brokerage account. And what I do know, so NCB Merchant Bank, what I'm familiar with NCB Merchant Bank, I'm familiar with them because I have a brokerage account with them. So I'm making mention, I know for sure that you can start a brokerage account with as little as $2,500. If you are on this webinar and you say, "Phil, boy, you get into about 2,500, I don't even have that." Again, that's okay. Because I'm sure enough, I'll tell you what, every $100 counts, every $100 gets into 200, 200 into 300. And if your goal is to get invested on the stock market, then you need to be very consistent and deliberate. And you can save up $2,500, right? So any one of these brokers will give you access to the stock market. The fees that they charge, most of them somewhere around the range of like 1.5%, but it's tiered meaning that, the larger the amount that you invest, they would lower the fees for you. So I would say, think of it this way. If you're investing $100, right? If you're investing $100, the cost of that investment, the commissions or the fees, is somewhere around $1 and could range between $1 to $1.50. So that's what you're going to pay the broker. The brokers have to get paid. They're the middleman, right? So if you have $100 to invest, the fee that you're going to pay to the broker is somewhere between $1 and $1.50 when you get the account open. And that's every time that you put through a trade, every time that you opt to buy stocks, right? Every trade that you do. This year, I just wanted to give you an idea. I told you that the stock market, it goes up and it goes down. This is, the returns on our Trinidad and Tobago Stock Exchange from 1984 to present. And what I want you to pay attention to, as I said, some years are better than others. Some years they may have negative returns, but the long-term trend of the stock market is up. I just was showing that the top performers of the stock market this year to date, you will see them there. I just thought that that's just again, these are not advertisements and these are not recommendations. I'm being very clear and I have to be specific because the regulators are very specific in terms of how financial advice and investment advice is disseminated, which is why I have to say that. Everything that you see in here is used as an example for you to have a real life picture of what happens. This is not pie in the sky. This is real hard data here in terms of the returns that the stock market has made and some of the returns that some of the companies have pushed out for the year so far. Here, I just wanted you to see this is just a graphical or chart representation of the numbers that you saw before to show you visually that even though the stock market goes up and down and it's up and it might be choppy generally over the long term, this is how the stock market goes. It goes up, right? So this is the TT composite and the all TNT index from inception to present. TT composite is just, we have some other stocks that are listed in other jurisdictions. So we have stocks from Jamaica. So you might see like Grace Kennedy and NCB Merchant Bank and those types of stocks that are domiciled in other countries, but they're also listed, cross-listed on our stock exchange. The composite index reflects every single company that's listed on our stock exchange, as opposed to the all TNT index is just only Trinidad companies. So I thought it would be useful to show these two charts. This is an example of Republic Bank and the total return over 30 years. So if somebody invested in Republic Bank from inception, almost, let's say, roughly 14,000%, that would be a return. Is the dollar value here of that, right? So I would say investing in the stock market is a great tool for your children. So even if you think it's not for you, and it's not too late to get started in the stock market, what I would certainly say is that you should be thinking about when you're coming a little closer to retirement, you do want to be reducing your risk, but you might say, boy, Phil, I'm 40, I'm 45, I'm 50. Is it too late? No, it's not too late, but it's certainly the point in your life where you need to be, hopefully you're earning a bit more. So you might be earning more than when you are 20 and 30 years old, so you can contribute more, but it is not too late to get started. But as you start to, when you reach retirement or after retirement, when you're at retirement, you don't want to be starting to invest in stocks at retirement because that's risky. That's when you want to now think about, you've accumulated this money and you want to have this money safe in a fixed income type product, or something that's not going to, you don't have to be subject to these fluctuations in the economy and how and what happens with companies because of what happens in the economy, which is up and down, and sometimes that could be very, very scary. The volatility in the stock market sometimes can make you sick. But the younger you are, the better, and you have more time to deal with those fluctuations versus someone who is at retirement, right? This example here, again, it's just saying, if you didn't start investing at 20, that is okay. That's fine. The object of these charts that I'm going to show you is really the importance of starting early, right? So the person who started at 30 and they invested, I use the average return of 8%. So let me just break down what this slide means. Someone started investing at 30 years old at assuming a rate of 8%. The reason I'm using 8% is generally over the long term, the rate of the stock market could fluctuate anywhere between 7 to 10% or 7 to 9%. So I went with 8%, middle of the road, a bit conservative. And you contributed $1,000 every time you got a salary, because remember, every paycheck you get, there's an opportunity to push towards your financial goals, right? And you only have a finite amount of salaries. So every time one salary goes or one earning opportunity goes, that's one less opportunity to move towards your financial goals. So you with this person invested consistently at 8% in the stock market, or probably in a mutual fund that's paying 8%. I know probably the question is going to be, Philip, what mutual fund in Trinidad is paying 8% now? Right now, none that I know of. But there are instances, again, it just depends on what's happening in the stock market, the type of mutual fund and what's happening in the stock market. But let's assume this person invested in the stock market at this average rate. Their ending balance is 600,000. Means that the total contributions would have been, so they did this for 20 years, right? The total contributions would be 240,000. What their earnings would be 360. So total would be $600,000. But check out the person who started at 20. Same 1,000, same 8%, but they have an extra 10 years in. That's 1.5 million, right? It's more than double. And the point I'm trying to get on here is the earlier you start, the better. The longer that you are invested is the better opportunity you give your money a chance to grow for you. You might be saying, but Phil, I don't know what to invest in. Or I want to learn about investing so I could do it on my own, so I could look at a financial statement and make my own investments, go to the broker and tell them what to do, because not every time a broker is going to tell you what to do. Or I just want someone to tell me what I should be investing in, what mutual fund I should be investing in, what stocks I should be investing in, how I should be positioned. Is it the right time for me to invest? I want that type of advice. So that there are lots of things that you could be thinking about. I just want to share this video.
Welcome to the Fill the Gap I Invest program. I'm Phil, and I am really happy you chose to take the next step in your financial journey with me and Team DTG. Now, when it comes to making big life choices, especially when it comes to money, we're all looking for a foolproof plan, 100% guarantee, which is probably why the question I get asked over and over and over again is, Phil, what is the best investment? Now, truth be told, there is no such thing as 100% guarantee, But what I can guarantee is by far the best investment you will ever make in life is the one you make in yourself. More specifically, in your financial education, which will have a positive impact on your emotional health. Now, whether you're here because you want to be able to pay your bills on time, every time, without worrying, provide everything you've never had or more for your family, start or expand your business, get married and move into a dream home, travel whenever you want to, have more than enough to pay off your credit card in full every month, understand how best to make the most of your inheritance, or you fill in the blank with your specific reason. This course is designed to meet you right where you are, and only you know exactly where you are. So where exactly are you? Now, while you take some time to think about that, I want you to know that my job is twofold. First, I'm here to give you the lowdown on the non-negotiables needed for building a solid financial foundation. That insider intel will help you to both identify and fill the gaps in your knowledge. Next, I'm here to encourage you to use that information to take confident action. Your job is to be clear on your personal and financial goals. You need to be honest with yourself, make adjustments along the way, but as long as you are patient and consistent, you will see exciting results. Here's what you can expect. There are 5 modules with topics and accompanying exercises, videos, and voiceovers for you to work your way through at your own pace. My suggestion is that you complete them in order, because as tempting as it is to skip to the good part, sometimes we need gentle reminders of stuff we already know. And who knows, you may even discover new ideas about those things you already know. I know you may be eager to get started investing, but before you begin your investment journey, it's important to assess your personal financial situation to know if it's the right time to start. The PTG resources and tools provided will help you to prioritize what's important to you and help you to align your finances with your values. I'm going to be with you along the way. You'll receive a monthly newsletter with gentle money reminders and information to motivate and empower you to take action and keep going. You'll have access to quarterly webinars that focuses on specific sections of each module with time set aside for you to ask questions and get clarification. You can also email any questions you may have. Now, before we go any further, please rest assured that I am also on a financial journey just like you. And even though we might be at different stages, I had to identify the gaps in my financial education and find the information to fill those gaps. Next up, we're going to look at where those gaps may be for you and how you can fill them too.